2026. Income Tax Act 2025 governs our Income Tax Act. So from the first tax year is 26, 27. This is the thing. Under the 1961 Act, every practitioner tracked two separate periods. So the new act collapses both into one. Previous year, the financial year in which income was earned, it was called a previous year, financial year 24-25. It was from 1st April 24 to 31st March 25. Income earned here is taxed in the next year, which is called the assessment year in previous act. The year followed the previous year was called an assessment year 25-26 for the income earned in previous year 24-25. Returns were filed and assessed in this year, assessment year, which was called. Now what has happened in under Income Tax Act 2025? A single concept covering the financial year in which income is earned and assessed. So example, tax year 24-25. So there is no assessment year for tax year 24-25, just one reference. So for return filing for 25 in the year 25, we will mention that tax year 24-25 returns are filed. So tax year 24-25 in the new act read as previous year 24-25 under Income Tax Act 1961 corresponding to assessment year 25-26. You will get this clear from this slide. So you see this slide. Period of income for previous year 1st April 2025 to 31st March 26. Now the new act has come from 1st April 2026. So the period of 2025 to 31st March 26 is governed by Income Tax Act 1961. So the assessment year concept still remains for the income for 25-26 because the act has come from 1st April 26-25 Act. So assessment year 26-27, income of financial year 2025-26. So return will be filed as per old forms for assessment year 26-27 for the last date 31st July for individuals and for 31st August for business income, 31st October for tax audits and 30th November for transfer pricing. Got it? The next year 26-27 is the new act, Income Tax Act 2025. So for the next year, the tax year 26-27 is applicable. So income of financial year 26-27 or tax year 26-27 return will be filed for tax year 26-27 in the next year 31st July 27, 31st August, 31st October and 30th November. So the difference is that when we filed our returns, we filed our returns as assessment year 26-27 for financial year 25-26. But in tax year concept, there is no assessment year. So for tax year 26-27, returns will be filed for 26-27 in 27 for tax year. So the assessment year word has gone. Only one concept is there, that is tax year. So everything will be done with tax year only. Suppose you get a notice of scrutiny, that will also correspond to tax year 26-27. I think everyone is clear about this tax year because there was a lot of confusion in assessment year and tax year. So government has made now that only tax year will be used from 1st April 26. So for this year filing, still old forms are used and assessment year concept still remains 26-27. Now I go to the previous slide. So the provisions deleted from Income Tax Act 2025 is sunset provisions. So many reductions and exemptions in the 1961 Act were introduced with specific end dates. Once those days were passed, the provision had no operative effect but remained in the statute, cluttering the text. So these sunset provisions were deleted. Provisions superseded by policy change. There were many government policy shifted and certain incentives were discontinued. So all these deductions, investment linked deductions are no longer needed and have been removed in Income Tax Act 2025. So technology that mandated physical processes, paper form, manual procedures, because now the returns are filed, e-filed. So all the rules which were mentioned in the old forms, old act are deleted because now we have electronic filing. So all the rules are as per digital formats. Redundant explanation and provisions are also deleted. And result, the overall tax is significantly shorter, making it more accessible to both taxpayer and professional without losing any operative tax principle. So these are the exemptions moved into dedicated schedules. As agriculture income is moved into schedule 2, certain exemptions to non-resident have been moved into schedule 14. There were many sections for non-resident. Now they have made it into schedule. So what has happened? 819 sections have been transformed into 536 sections in 2025. So 511 rules have been converted into triple three rules. 399 forms, 195 or 90 forms, and 16 schedules. So major revamp has been taken in the Income Tax Act 2025 to make it easy to read. So the tax year concept is the new change in the act. Now, interestingly, the 1961 Act is not repealed. It still remains because many cases which were filed under 1961 Act will go on in future according to the 1961 Act. The e-filing portal also is open for 26-27 assessment year. So circulars, notification and approvals, instructions, notices are also valid for 1961 Act because assessment can take place accordingly because the new act comes from 1st April 2026. So all the assessments or the returns filing will be done in the next year and the new forms. So till now, as on date, we are under 1961 Act for filing for this assessment year. For assessment tax year 26-27, advance tax you have to deposit under 26. Suppose somebody wants to deposit advance tax in 15 June, 15 September 26, then they have to choose tax year 26-27. But if they have to deposit self-assessment tax for 26-27 assessment year, then they have to go to 1961 Act. Because on e-filing, now they have done, what have they have done is, they have given two options, 1961 Act, 2025 Act. When you click on 1961 Act, then the challans for assessment year will open. And if you click on 2025 Act, then their challans for 2025 tax year will open. So that you have to be very careful that for which tax year or the previous assessment year depositing tax. That you have to check on the income tax side, that you have to be very careful for which tax year or assessment year you are depositing the tax. Mainly the advance tax or the TDS allowance for tax year 26-27 are deposited under 2025 Act now because we are standing in July. So for return filing for 31st March 2026, assessment year 26-27, we'll use the old Act and deposit challan accordingly for assessment year 26-27, self-assessment tax. Are there any questions? Then you can drop in chat box for this challan deposit or tax year concept. So the new regime stays the default. Now, India has a two regime policy. So old regime where all the deductions were available and the new regime. So in the new Act 2025, the new regime says the default. Previously also in the 1961 Act for the last 2 years, the new regime is the default regime. Default regime means that if you want to change from the new regime to old regime, then you have to fill a form. Otherwise, you are in the new regime. And for the new regime, I'll let you know the tax rates. Tax up to 4 lakh is nil, new regime. And after that, there are slabs 4 to 8, 8 to 12, 12 to 16 that I'll discuss later. So 115 BAC is the default regime. New regime applies by default unless old regime is explicitly opted. But peak rate in the new regime is 30% for individuals on income above 24 lakhs in the new regime. So the 4% cess is extra. So this is the basic framework of 2025 Act. There are small changes for business and professions that will not be affected. The individuals are not affected by that. All the non-residents, there is not enough changes for 2025 Act. It remains the same as 1961. So residential status. So first of all, for non-residents, it is very important to know that whether you are a non-resident or a resident, when an individual taxability turns on residency, not citizenship. Why? And how ROR and RNOR and non-resident status is determined. So This is a very important concept. Citizenship is not the same as residency. So someone can be a foreign citizen, but can be a resident of India, and an Indian resident or Indian citizen can be a non-resident. So an individual taxability in India depends on the residential status for that particular year, not on citizenship. So an Indian citizen can be a non-resident and a foreign citizen can qualify as an Indian tax resident. The Act qualifies every individual into one of the buckets below. A resident can be, residential status can be resident, deemed resident, and non-resident. And resident can be ordinary resident and not ordinary resident. So, why do we need to know the concept of resident and deemed resident and non-resident? Because resident, all the global income of a resident, whether received, accrued, or deemed to be received or accrued in or outside India, is taxable by India. So a resident person, all his global income, he is earning income in US, Saudi, and he is a resident, then all his global income will be taxable by Indian government if he is a resident. If he is a resident but not ordinary resident, so all income accrued or received in India plus income from business controlled from India or a profession set up in India will be taxable in India. And for non-resident, only income deemed to be accrued, received, or to be received in India will be taxable. So his global income will not be taxable. Only Indian income accrued or received in India will be taxable. So this is the difference between resident or non-resident. Why do we want to? Because resident global income, you have to be very careful that a resident global income is taxable. So when is a person resident in India? If his stay in India is 182 days or more in the previous year, or stay of 60 days or more in the previous year and 365 days or more in the 4 year immediately preceding it. Indian citizen, person of Indian origin visiting India 182 days or more in the current year triggers residency. So this is the basic rule for who is a person resident in India, when is a person resident in India. So you can apply this rule and check whether you are a resident or a non-resident. And what is the meaning of income accrued or received in India? Accrued, deemed to accrued in India, income earned from any source located in India. So if you have any property in India and you earn a rental income, so source is rental property in India. So that income is accrued or deemed to be accrued in India. Received, deemed to be received in India, any other income actually received in India, regardless of where it is earned, that is also taxable by India. Income both accrued and received outside India stays outside India, tax even if it limited later. So income accrued outside India, but received after remittance is not taxable in India. And you can get a DTA relief if a resident global income is taxable in India and also in the foreign country, then the relief for foreign tax paid is available under India DTA with that country. So mainly the resident income is globally taxable and non-resident income is only accrued income which is taxable in India, income deemed to be accrued. So Section 9 of 1961 Act dealt with accrued, deemed to be accrued in India. So if a person in Saudi is a professional and he gives a consultancy service to an Indian company, so what happens is he bills a consultancy bill. So what happens is FTS, fee for technical services, is mentioned in Section 9, and which says that consultancy income is deemed to accrue or arise in India. So you are in Saudi, you have never come to India. So there is no PE, no business connection in India. Still your income is taxable in India because as per Section 9, it is a deemed to accrue or arise in India. So you have to pay tax, you have to pay tax on that. Your TDS will be deducted, withhold it. And after that, if you want to take a refund, you have to file income tax return in India and claim refund or pay tax. So these are the concepts of accrued or arise in India. You can definitely claim a DTA relief under Independent Personal Service, Article 15 of India DTA, India Saudi Treaty, if you are an individual. But if you are a company, then it is not applicable. And in the Independent Personal Services, it is mentioned the services which can be claimed under Independent Personal. Suppose you are a lawyer, doctor, then you can claim relief. But for the relief, you need a TRC and 10F that we'll discuss later. How can we claim a relief? But First of all, your income is taxable in India because of source rule. India follows a source rule. So source of income is taxable in India. So mainly you have to see whether income is accrued or arise in India. Source rule. Many countries follow source rule and India is the same. So the source rule is the main criteria for taxing the non-resident income. Now, for the source rule, first comes the income from house property. So this house property, if a non, if a what, when is a person resident in India that I have discussed? Now, self-occupied property. If you have two properties for own residential purpose, they can be taken as self-occupied properties. So that for that, gross annual value will be nil, and 2 lakh of interest can be taken for a maximum of two self-occupied properties. If the owner cannot actually occupy the property, still it is called a self-occupied properties. And let out property. What is a let out property? Which is let out for residential or commercial rented for whole or part of the year, or any property beyond the two self-occupied is treated as self let out. So gross annual value is computed and municipal taxes is deducted. 30% reduction is applicable, and interest has no ceiling for 2 lakh. Ceiling is not applicable on let out property. So I can give you a rent from a property located in India and always taxable in India for an NRI. So the location of the property determines the source, which I told you earlier. The source is the property located in India. So that is why it is taxable for a non-resident, because your property is located in India. So the source is in India. So income is deemed to arise in India. So you have to pay tax in India for that rental income property situated in India. The same rental income may also be taxable in NRI's country of residence, since most country tax resident on global income. So all the countries tax on global income. So your resident country will be also taxed, but you can claim a DTA with India double taxation relief. So tax is generally not levied again in the country of residence. So when no DTA exists, then tax may be payable in both India and the country of residence. So the DTA comes into play when both the countries charge tax on the same income. So the deductions from income of house property is MCD tax, standard deduction 30%, and interest on borrowed capital. Non-resident can claim all deductions available too. The resident can also claim MCD tax, standard deductions, interest on borrowed capital, and same the case, the non-resident can also take the same deductions which the resident can take. So there is no difference between deductions for a resident and non-resident in income from house property. But the source rule, because of the source rule, it is taxable. So interest on borrowed capital key rules is capped at 2 lakh per year. Cap of 2 lakh applies for acquisition complete within 5 years. Not condition not satisfied, 30,000. Pre-construction interest is claimed in 5 equal installments. For let out and deemed out, there is no cap on interest, but total loss of the house property is restricted to 2 lakh per year. Balance loss can be carried forward for 8 years. This is for interest on borrowed capital and is applicable to non-resident also. So for this, I have made a computation. So rental income, if your house is self-occupied, meaning that you are you have not given this on rent. So the rental income is nil, and municipal taxes 30% will not be and less on interest on if you have borrowed the money to purchase that property. So it is capped at 2 lakh. So what will happen? It will claim a loss on this property. If let out, then actual rent, less municipal taxes, less 30%, less interest, and that income will be taxable. And if it is deemed let out, because if you have two or more self-occupied properties, then the third property will be deemed let out. And for that deemed let out, you have to pay tax on deemed rent. The deemed rent is, there is a formula for deemed rent, MCD tax, and that there is a formula where you can calculate the deemed rent. So loss from house property can be set off against other heads and also can be carried forward for 8 years. So every non-resident has a property in India, so that income will be taxable, and you have to calculate the computation of rental income like this. Rental income less MCD less 30. Nothing else will be available for rental income. You can deduct MCD tax. 30% ad hoc deductions is for expenses to maintain the property, and interest on borrowed capital for capital loan taken for purchase of property, that is capped to 2 lakh. So these deductions are available for income from house property for a resident also and for a non-resident also. So the balance income will be taxable. So this is for interest on income from house property. So now we can come to income from capital gain. So many people have properties in India. So this is a very important topic. So properties and shares, mutual fund. So these are also sourced in India. So that will also be taxable in India for non-residents. So first we have to check, when does a capital gain arise? So any gain arising from the transfer of a capital asset are chargeable to tax under the head capital gains. So both words are important, transfer and capital asset. So what is a transfer? Transfer is sale, exchange, relinquishment, compulsory acquisition, conversion into stock trade, and it is not limited to simple. So relinquishment of rights. Suppose your property is acquired by the government. So that is also a relinquishment. So that is also a sale. So that in that case also capital gain arises. Compulsory acquisition. So all these in these cases transfer take place, and so capital gain arises. And capital gain arises in the tax year in which transfer took place. Now it is called tax year. Previously it was called previous year. The Income Tax Act allows exemptions against capital gain if the capital gain amount is reinvested into specific asset within the prescribed period. Discussed in exemptions section 54, 54B, 54EC, 54F. So capital gain arises from transfer of a capital asset. So first you have to look whether it is a transfer and it is a capital asset, which is. So what is a capital asset? So this is what is a capital asset? Land, building, shares, securities, goodwill, patents, trademark, brand names of a business, personal effects, even jewelry, collection, drawing, painting, sculptures, any work of art, all these are capital asset. So if you sell these, then capital gain arises. Tenancy right, development rights, compensation route, and other tangible. All these are capital asset. What are not the capital asset? Gold deposit, bonds, rural agriculture land. That is a very complicated definition of rural agriculture land, which is situated outside municipal area, and there is a 3-4 demarcations of that. Population below 10,000. Stock in trade, other personal effect, movable such as personal car, furniture, wearable instrument, utensils, other than jet pass, which is called jewelry article. Other than that, they are not capital assets. So transfer on these assets, capital gain does not arises, but capital gain arises on these assets, land, building, shares, securities, goodwill. So all these sale, jewelry, gold, drawings. So on all these, capital gain arises. So you have to be very careful when selling these, that you have to pay taxes in India on the capital gain portion. Clear? So capital gain of a non-resident is also with source rule, which I told you earlier. So as per section 5, a non-resident tax on income received, deemed to be received, or accrued, deemed to accrue in India. Section 9 provides wide source rules. Income arising through any property, asset, or source in India or through transfer of a capital asset situated in India is deemed to arise in India. So I told you earlier, section 9 of the Income Tax Act 1961. It previously it tells us that which are the income which are sourced to India, and that's why the non-resident have to pay tax, because they are the income which are deemed to accrue or arise in India. So in capital gain or rental income, it is mentioned the income arising through or from any property, asset, or source in India or through transfer of capital asset situated in India is deemed to arise in India. That's why capital gain is taxable. Section 67 charges profit from transfer under the head capital gain taxable in the year of transfer. Basic principle is only capital gain from transfer of assets situated in India are taxable in India for non-residents. Foreign source capital assets are not taxed in India unless treated as Indian source under domestic law DTA provisions. So foreign source capital gains are generally not taxed. If you have a property outside India, China, and you sell it, and you have a capital gain, then Indian government can't tax on that. Otherwise, unless and until there is some arrangement of tax or treaty abuse that we can discuss later. So unless and until that doesn't happen, if a property is situated in India, then only non-resident have to pay tax on capital gain and on rental income also, which I told you earlier. So this is the basic resident, non-resident rules for capital gain. So I have made an short term. There are two types of capital gain: short term, long term. So previously in Finance Act 2024, now they have made very simple. They have made two categories only for 24 months and 12 months. So property held as capital asset is 24 months, listed security 12 months, unlisted 24 months, other assets 24 months, meaning thereby that short-term capital gain arises when the asset is below the specified threshold. So these are the threshold for long-term. So if a property held as a capital asset means immovable property, land, building, or parent thereto, if it is sold before 24 months, it's a short-term capital gain. If it is sold 24 months or more, then it is a long-term capital gain. For listed securities, shares on which STT is paid, equity-oriented mutual funds, zero coupon bonds, the period is 12 months. So before 12 months, if you sell them, then it is a short-term capital gain. If it is sold 12 months or more, then it is a long-term capital gain. Similarly, in unlisted shares, 24 months. Before 24 months is short-term, more than 24 months is long-term. And other assets, debt-oriented fund, market-linked debentures, etc. Same 24 months. Before 24 months, it is a short term, and more than 24 months, it is a long term. So for short term and long term, there are different tax rates. That's why we have to differentiate between short term and long term. Short term capital gain arises when the asset is sold. Long term capital gain once the asset is held beyond the threshold limit. So this is the two holding periods chart, 12 months or 24 months. So effective 23rd July 2024, the three-tier system has been done away with. So now India follows 12 months and 24 months chart. So this chart tells us all the financial assets tax rates and the short term, long term, whichever is applicable. So for depreciable asset for business, it forms block of assets, car, furniture in the business. So it is always short term. So in a business entity, if you are maintaining a business entity, all the assets form a block of assets, and all the assets sold are deducted from block. And the remaining, which if a block is totally sold, then it is always a short term. So listed equity shares on which STT is paid, units of equity-oriented mutual fund, units of business trust, listed government. So earlier I told you that it is a 12-month period for determining long-term, short-term. If it is greater than 12 months, long-term, less than 12 months, short-term. And the tax rate is 12.5% over 1.25 lakh. 1.25 lakh is the exemption for long-term capital gain. So over 1.25 lakh, 12.5%. And if you sell it after 1 year, then 20% short-term capital gain. So specified mutual fund means the greater than 65% in debt. These are called specified debt-oriented mutual fund, market-linked debentures. These are always short-term, and slab rates are applicable on these. The mutual fund, if you sell, then always slab rates are applicable. So you will not get any benefit of short-term rates or long-term rates. So you have to be very careful about selling mutual funds. Listed securities other than the above, including ETFs, exchange traded funds, which are now popular. So again, it's the same thing. Greater than 12 months long term, less than 12 months short term. And long term capital gain is applicable at 12.5, and short term is slab rate. Slab rate means the slab in which your income comes 10, 20, 30% as per slab. Unlisted shares, same, greater than 12 months, 24 months long term, less than 24 months short term, and long term capital gain 12.5%. Short term is slab rates. Land and building, I told you earlier, greater than 12 month, 24 month long term, less than 24 months short term, and long term capital gain 12.5% or 25% with indexation. That I'll tell you, the non-resident doesn't get the benefit of indexation. That I'll make you clear. Short term capital gain is slab rate. So any other capital asset greater than 24 months long term, less than 24 months short term, and long term is 12.5, short term is slab rate. So this I have made the computation for long-term capital gain for non-resident. So the non-resident now have the Income Tax Act have made it very simple. For resident, they have made indexation also available for, but it is not available for non-resident. So non-resident can has the only option of selling the property and deducting the cost of acquisition from it. The remaining portion you taxes at 12.5% and 4% cess and total tax payable, and that you have to pay, and then you can remit the money remaining out of India. So now it is very easy for a non-resident to compute his tax for long-term capital gain on selling of immovable properties. I have given an example on this slide. Residential flat in India, purchased April 2022 for 50 lakh, sold in May 26 for 1 crore 20 lakhs. So holding period is more than 24 months. So that's why it is a long term. So sale consideration 1 crore 20, cost of acquisition 50, long term capital gain is 70. So tax rate is 12.5 to 8 lakh 75,000, cess 4%, 35,000. Total tax is 9 lakh 10,000. So buyer will deduct TDS on the gross sale value under section 393(2). So buyer will deduct TDS on 1 crore 20 lakh at the rate of 12.5%. So the non-resident have to file his income tax return and claim a refund on this, because tax will be deducted on 1 crore 20 lakh at the rate of 12.5%. Seller may apply for a lower. So what can non-resident do? He can give this computation to, there is a form number 13 where we can, non-resident can apply to a AO for lower reduction of tax. And he can show this computation that my taxes come on to 9 lakh 20,000, 10,000 as per my cost of acquisition. So the AO will study the case and then he'll give a low reduction certificate. So suppose the tax comes to around 3-4%. So the 4% certificate will be issued, and then the buyer will deduct only 4% on the basis of the certificate given by the AO. So he can save his cash flow in 8%, and then he can remit the difference money outside India. So this is very important for non-resident. This non-resident concept of selling of immovable property, because we get many cases in India where the non-resident have property in India and they want to sell the property and take the money outside India. So we can apply for lower certificate though AO and claim lower certificate, lower tax rate, and then the non-resident can save the amount of tax which may have been deducted if lower certificate has not been obtained. So here you can save the taxes by consulting a tax person who can apply on our behalf for lower tax reduction in the department. So you have the two options: first to deduct 12.5% plus cess, or you can apply for low reduction in the income tax department, and then you can save the tax. So this is for listed equity shares. So purchase price is 20 lakh, sale price is 60 lakh, holding period 3 years, STT paid. So this is a long-term capital gain on listed shares. So 40 lakh less exemption threshold, which I told you, 1 lakh 25,000, you'll get an exemption from long-term capital gain. So taxable LTCG is 38 lakh 75,000. So tax at 12.5 plus cess. So 5 lakh 3,000 is the tax for non-resident selling listed equity share, STT paid. Sale price was 60 and purchase price was 20. For a 6-month holding period, STG is taxed at 20% for non-resident. In this case, broker may deduct TDS under section 393(2). A beneficial DTA rate may override the domestic rate. So the DTA benefit can be taken if you see the TT, and if you think that the tax rate is beneficial in DTA, then you can give the certificate to the broker and he can deduct lower tax. But for that DTA benefit, you have to take the TRC and 10F, which I'll discuss later for the DTA benefits. Otherwise, 12.5% and 4% your tax will be deducted. So this is land building acquired up to 22nd July for resident. For resident, they have given, I told you earlier, there are two options. So purchase and sold up to 22nd July 2024, tax at 20% with indexation. And possibility two is purchase and sold after 23rd July, tax at 12.5% without indexation. Purchase up to 22nd July, sold after 23rd July, lower of 20% with indexation. Or so the possibility three is available to resident only. For non-resident, this possibility 3 is not available. For non-resident, I told you earlier, sale price of property minus purchase price, the difference you have to pay 12.5%. You don't have the option for indexation, which the resident individual has. So, because they have made the change for residents individual, not for non-resident. For non-resident, the new scheme applies where the difference have to be paid at 12.5%. For resident, they have made two options available. You can calculate as per indexation and also as per 12.5% difference. Whichever benefits it acquired, that possibility can be taken by the resident individual, but not the non-resident. So that can be planned also, that you have to be a resident or not. That's why I told you earlier also, for a resident and non-resident, you have to check when, suppose you are about to sell a property next year, big property. So if you become a resident, then you can have the option, both these options. But for non-resident, that option is not available. So that tax planning can be done if the property is big and you think that tax can be saved. Other rules for capital gain is 50C for long land and building. If the you have to be very careful that the stamp duty value is treated as, because the stamp duty's value is treated as full value of consideration. So in India, if you sell a property, there is a concept of stamp duty value. So you can't sell below the stamp duty, because if you sell below the stamp duty, section 50C will be applicable. And according to 50C, full value of consideration as per stamp duty will be taken. So 10% difference can be is allowed if stamp duty value is less than 110% of the sale value, but not more than that. Suppose you sell a property in New Friends Colony in Delhi. So in New Friends Colony, the rate is 7 lakh per gaj. So 200 square yard is 14 crore. And your deal, you have the deal is actually finalized for 10 crore. So the difference of 14 crore, 14 minus 10, 4 crore will be deemed capital gain in your hands, because it is more than 10% difference. Got it? So the government says that as per stamp duty, you have to make the payment. So there is a litigation point here as well, because when I told you the New Friends Colony, actually the New Friends Colony, the rate is 7 lakh, but stamp duty's rate is 7 lakh, but actual dealing is done in 5 lakhs. So that litigation is possible, but otherwise you have to be at the stamp duty value only. If you deal without below stamp duty, then sale consideration will be taken as stamp duty value. So this point is very important. Section 50C. Buyback of share. Entire buyback consideration is treated as dividend from 1st October 2024, and the cost of acquisition of the buyback becomes a capital loss. But now again, they have changed in Income Tax Act 2025. From 1st April, consideration to a shareholder other than promoter instead tax under capital gain, not as dividend. So now it is again changed for 26-27 tax year. But before it was, the entire buyback was treated as dividend for financial year 25-26. But now it is again taxed under capital gain, not as dividend. Bonus and right shares. Cost of acquisition of bonus share is nil. Cost of right share announced in other fair is nil. So nil minus the selling price is capital gain. And joint development agreement, it is a complicated issue in which deemed sale is applicable as per the SDV of assessee share in land building plus money received less index cost, that is for resident individual only. So what have changed? What exception remains? Until 22nd July, indexation was available under the second provision for certain long-term assets. This allowed taxpayer to inflate the historical cost. Now it has gone. From 23rd July, indexation has been received for all except one specific case, land and building held by a resident. So again, I'm specifying this, that from 23rd July, indexation has been removed for all assets except one specific case, land building held by a resident individual or a chief, and not for non-resident, acquired up to 22nd July. For that exception, taxpayers compute both ways, 12.5% with indexation, without indexation, 20% with indexation. So for non-resident, this is not available. For all other assets, long-term capital gain is simply the difference between the selling price and the original price with no inflation adjustment. This makes computation simpler but can make higher taxable gain on assets held for a long periods. So if it is a long period, then capital gain may arise higher. So the cost inflation index for 25-26 is 33.76. So it has become very simple. Sale minus purchase, and then you apply the tax rate. Inflation is available only for resident in case of land and building sales. Otherwise, it is not available, and non-resident, it is not available at all. The stamp duty deeming provision I have told you, 50C. So 10% tolerance level that I have told you earlier also. And the valuation officer route, I have told you that in litigation, if the actually the property is of the amount lower, then you can go to the valuation officer and he can determine the actual value. And if he determines the value actual, then you can capital gain can be saved. Otherwise, the valuation officer value is taken. Bonus shares, right share that I have told you earlier also, that remains the same in new act also. So chapter 6A deductions, ATC, ATG are not allowed under LTCG. So LTCG is simple computation, sale minus purchase, you have to pay tax. Nothing is allowed under short-term, long-term capital gain under section 111A. Rebate is also not available, 87A under 112A listed gain in both old and new regimes. For STCG under section 11A, rebate under section is available in the old regime, but the thing is that the non-resident doesn't get the rebate under section 87A also. This is also the major difference. So the non-resident have only the tax slabs to play with, up to 4 lakh, 4 to 8, 8 to 12. So the resident has the 87A rebate up to 12 lakhs, but non-resident does not have that rebate. The benefit of a basic exemption limit, if total income reduced by is below the basic income, the shortfall can be adjusted against it, and only the difference is charged at the applicable state. This provides some relief to lower taxpayer. Suppose the non-resident have a 4 lakh capital gain, long-term capital gain. So the slab is 4 lakh, and if it has a 4 lakh capital gain, then his income is nil. So he doesn't have to pay the 12.5% or the 20% on that capital gain, because he has the only the capital gain income of 4 lakh. So the slab rate benefits is consumed in the long-term capital gain or short-term capital gain. So if you have a small amount of long-term and you don't have any other income, then the slab rate will take effect and you don't have to pay any tax. So the basic exemption limit talks about this only. So the exemptions for 54, that 54B, that remains the same. So the individual HUF sells long-term residential house. One residential house, purchase 1 year back, 2 year forward, construct 3 years forward, lock in 3 years. The 54 exemption is available. So if you sell a residential house property in India and purchase another residential house property, then you don't have to pay any long-term capital gain and you can claim reduction under section 54. So for the time limit is 1 year back, 2 year forward, or construct 3 year forward. So these are the time limits you have to take care of. And before filing of return, if you don't want to purchase the residential house, you have to keep it the amount in capital gain account scheme. 54B is for non-rural agricultural land. So you have to purchase another agricultural land, 2 year forward, lock in 3 year. 54EC is any person sells long-term land oblique building. So you can any residential house or commercial. So you can purchase 50 lakh bonds for NHAI REC PFC. 6 months forward, within 6 months, within 6 months of the selling, and lock-in is 5 years. So you can claim exemption under section 54EC. And 54F is for non-residential house. So you can purchase a non-residential, you can sell a non-residential house. Suppose you sell a commercial property. So you can purchase a residential property, purchase 1 year back, 2 year forward, construct 3 year forward, lock-in is 3 years. So you can claim an exemption under section 54F. So 54 is for what is the difference between 54 and 54F? 54 is for residential house sale and 54F is for non-residential house. But there is an exception in 54F. You can't have more than one residential house in your name for claiming exemption. In 54, you can have any n number of houses, but in 54F, you cannot have more than one residential house for claiming exemption. So 54, an SSE may invest in two residential houses where long-term capital gain does not exceed 2 crore, but this two house option is available only once in a lifetime. So that you have to take care. 54F requires invest in whole net set consideration to calculate. It is only the section with this requirement. Partial investment gives proportionate. So you have to invest whole amount for getting exemption under section 54F. So the 54F condition 1 on the date of the SHC that I've told you earlier also, the 54F, the condition is that the SSE must not hold more than one residential house other than the new one. And the SSE must not purchase another house within 2 years or construct one within 3 years of the transfer date. Doing so withdraws. So 54F, there are many conditions which you have to satisfy for claiming exemption under 54F. For 54, you can invest in two houses, but not more than 2 crore. But this two house option is available only once in a lifetime. So that you can claim for residential house taxation. So this is all about capital gain. So I've told you about rental income, capital gain. Any questions up to this? Any questions, Sumit, for any?
So, Karan, there have been two questions. First of all, is mutual fund, just a second, I'm checking on the chat. Uh, for mutual fund, is there any provision for NRI where the capital gain is exempt? That's the first question.
Yeah, mutual fund for Saudi, there is a double taxation avoidance agreement between India and Saudi where you can claim exemption, but for that you have to take TRC and 10F, tax residency certificate of Saudi, because as per Article 13, I think 13.3 of the India DT, the mutual funds are exempt as per treaty, not as per the Indian Income Tax Act. So if you go to the treaty, then it is exempt. For that, you have to take TRC and 10F. So if you sold a mutual fund in India with an agent, you first give him the TRC, tax residency certificate, and 10F online. Now the form is to be filed online. 10F form is to be filed on income tax website. And for that, you have to file the form and acknowledgement comes. And TRC and 10F, both online acknowledgement, you have to submit it to the broker and then you can get the deduction from the mutual fund house which has sold. So correct, the mutual fund exemption is there for Saudi people. It is not for every country, but Saudi India treaty, there is an exception.
The second question is that if an NRI pays taxation in India as well as in another country, how can they avoid paying tax twice?
So the double taxation avoidance agreement comes into play. So if he is a non-resident, he will file his global income is taxable by Saudi, which I have explained earlier also. So Indian income, if in India it is taxes deducted, and he can claim a double taxation relief in Saudi Arabia by taking the TRC and 10F and telling the Indian government if the DTA has a lower tax, then he can claim that. Otherwise, he can file the return and claim rebate under Saudi for double taxation relief, DTA relief.
Okay.
File form 67 for double. Suppose a person is in India and he is claiming he has a salary deduction in US and he is a resident. So we file form 67 and claim rebate under section 89. So the same principles in Saudi also he can claim refund.
Okay. And the last question, I think it's on agricultural land sale is liable to capital gains.
No, agricultural land, I told you earlier also, agricultural land, the difference is the rural agricultural land is not a capital asset. There is a slide actually. There are two type of agricultural land in India: rural agricultural land and urban agricultural land. So the definition which I told you earlier on capital gain is transfer of a capital asset. So for a capital asset to become a rural agricultural land is not a capital asset, and therefore it is exempt. But for the proof of rural agriculture land, you have to prove that rural agriculture land is situated outside MCD area of 10 kilometer and population is not there and agriculture activity is there. So you have to prove that it is a rural agriculture land. So in registry also in India now it is mentioned that it is a rural agriculture land situated outside MCD area. So on registry, I have seen nowadays registrar has taken because the income tax department see the registry and check whether it is a rural agriculture land or a urban agriculture land. So if it is a rural, then it is exempt, and you have to prove that it is a rural agriculture land. And there are three categories up to 10 kilometer. The population should be this, 4 kilometer this, 6 kilometer this. So you have to prove as per the rural agriculture land definition that it is a rural agriculture land and then it will be exempt.
Okay.
But
So if anyone wants to ask more questions,
yeah,
they can
up
directly
till
ask
this
right
income
now.
from house property, capital gain, and income deemed to crore rise in India for non-resident.
So if and
Yeah.
yes,
Hello. Yeah, Yogaraj, sorry, I cannot raise hand or type. Actually, there is no option for me.
No, no, you can ask the
So,
question. You can ask the question.
okay. So, regarding Form 13, you mentioned
Hmm.
for low reduction certificate
Hmm,
for
hmm,
NRIs,
hmm.
especially for flat and property sale. But
Hmm.
is there any such option available for sale of equity? The next slide was sale of equity. So, is there any way we can have a reduced rate in case of sale?
Yeah, that can also be done. For sale of equity, also you can file Form 13. This amendment has taken recently only, where you can
Mm-hmm.
file Form 13 for any income.
Okay, for any, all
For
right.
any
Uh,
income. Yeah, this is the new amendment which has taken place that I missed it. But now for Form 13, you can file for any income, for any income, for whether it is a house property income, rental, interest, dividend, any income you can file for 13.
okay, thank you. Other is regarding stamp duty value. So,
Mm-hmm.
what is this stamp duty value, and who, like, how would I know that how much is the value of the property?
So what happens in India is that when you go to a registrar, there is a concept called circle rates in all over India. So in Delhi
Hmm.
also it is divided into A, B, C, D category circle rates. So when you go to sell a property, the registrar will tell you that it is a predefined minimum circle rate for which you can do a registry. So if a area has a 1 lakh per square yard circle rate and it is a 200 square yard plot, so for 2 crore, below 2 crore, you can not, as per Income Tax Act, 200 square yard value is 2 crores. So you cannot sell below 2 crore. If you sell it below 2 crore, suppose you have an agreement with the buyer that I'll sell
Hmm.
it for 1.5 crore. So the income tax will assume that 50 lakh is given in cash. So you have to mention in sale consideration as 2 crore, deemed income of deemed capital consideration of 50 lakh. Got it?
Okay. Be it anywhere within a metro area or outside metro
Yeah,
city,
outside
anything like
metro also. Now the circle rates are in remote villages. There it is not available in remote, but otherwise other cities, small cities also now circle rates are applicable. So at the predefined circle rate, you have to say take the sales consideration. So we give the advice to the client that don't sell it below circle rate. Otherwise, it will be a deemed sale consideration, and then you will trapped into litigation.
Okay, okay, great. Thank you. Regarding, sorry, I've listed some questions.
Oh, no, no.
Regarding tax residency certificate, I'm
Hmm.
residing in Saudi Arabia.
Okay.
So I think I can opt for it. I tried from their website, government website, but was
Hmm.
facing some issue. My question
Hmm.
here is, I've been residing for more than 3 years now,
Hmm.
but so far, whenever I try, I could not get it. If I get it sometime sooner now, will
Hmm.
it be applicable for previous year's tax paid as well?
No, 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 because what happens is now the tax agency certificate is year wise. So the acknowledgement will you
Oh
get
yes.
will be for
Hmm.
tax. It will be mentioned that it is for calendar year 26. So 26 is for India 1st January 26 to 31st December 26. For this period you can take the benefit, but not for the previous 25-26 calendar year.
Okay, I think I was looking, and in the drop down there were multiple years section, not only
Hmm.
current year, but it was for some previous year. So if I
Mhm.
get to download that for even
Mhm.
earlier years, it can be benefited.
Yeah, it can be beneficial. If you can get the 25, 24, then you can take the benefit of tax treaties.
Okay, even if tax is paid in earlier years.
Yeah, definitely.
All right. Now another is regarding TDS actually. Recently, I mean few years back, I had bought a apartment flat and
Mm-hmm.
I paid the TDS fees for that.
Mm-hmm.
But due to some times, because I was paying at the midnight, the deduction happened twice instead of
Mm-hmm.
once. I've
Mm-hmm.
been chasing for this to settle it down. I was expecting instead of two times, one of that time should be paid back to me, but I'm facing some issue. So, but this is around 5 years back. Can I still look for it and
Yeah,
fight
you can
against it?
get the refund. You can get we can try it at the income tax department that because if you have paid the twice amount, then the government is liable to pay the refund.
Okay. I believe until 8 years I can look for.
Yeah,
Is
yeah,
it
yeah,
true?
yeah.
Okay. All right. Thank you very much. So far, it's been very good. I appreciate your time.
Thank you.
That's it from my side.
Okay. So, Sumit, should I continue?
Hello, Mr. CA.
Yes.
Mr. Agrawal, how are you?
Fine.
I have few things because just I entered
Yes.
regarding equity and mutual fund investment,
Mm-hmm.
long-term and short-term capital gain.
Mm-hmm.
What is the new rule for save that tax?
So I told you in the previous slides I have mentioned that for long-term capital gain on STT paid, the tax rate is 12.5%, 12 for
Right?
12 months, and after 12 months it is 20% for non-residents also. The same is for resident
Yes.
and non-resident. So
Yes.
if you want to save tax and if you are dealing frequently in the shares or it is an investment portfolio.
Yeah, there is shares like demat accounts and all, and
Mhm.
equity and mutual funds.
Mutual funds, I have told you, I've explained that you can claim an exemption in DTAA. There is a clause in Article 13(3) of India-Saudi Treaty where it is
Yes.
mentioned that equity is taxable but not mutual funds. So now, what can you could do? You can do is you can take a tax residency certificate and a form online 10F form, and you can submit that to your broker or your mutual fund agency directly,
Mm,
and then they will not deduct any tax, and that will be claimed as an exemption after sale.
okay.
So that you
In
can
this
do, but
case,
you.
what happened? I have done many mutual fund investment directly, not through
Okay,
ARN or
okay,
broker or somebody.
okay,
So
okay,
in
okay.
this case, what when I'm going to the any because they said directly, if you go directly, it will take time. Sometime the AMCs are refusing
Hmm.
also
Hmm. Hmm.
uh,
Hmm.
due to some KYC reason or they
Hmm.
something I don't know. When I'm
Hmm.
going to them, they are saying, no, you have to change the ARN code. You should put our code, make it regular plan. So they want to get
Hmm.
their commission from
Yes, correct.
our investment.
Hmm.
So this is also another hassle. I
That
don't
I have
know.
to check. That I have to check that how can you, because without any broker, how can but you have to you can take talk directly to the AMC, the direct
Um,
mutual fund
the
company. You
hassles are
can.
what we are here
Mm-hmm.
and we have to go there. Then we have to run each and every AMC's different offices, submit
Mm-hmm.
document, then wait for the
Yes.
confirmation.
Mm-hmm.
Whether if there is sometime the document rejection also will be there. Like
Mm-hmm.
they say no, the sign are mismatched or this need another
Mm-hmm.
document, another kind of attestation, this that.
So the TDS is deducted on your cell or it is not deducted till now?
Did they are deducting?
They are deducting, na? So what
Yeah,
can you
TDS
do
deducting.
that TDS is deducted? It is called withholding tax. So the tax
Mm,
is deducted, but if you file your income tax return in India and claim a
yeah,
DTA, then you can claim the refund on that DTA. But you have to take the PAN
yeah,
number
but
in India
yeah,
and
but it's only covering 1.25 annually. It's, lakh 1.25 lakh.
25.
1.25 1 lakh 25,000 only covering for the any tax gain.
gain, na? So
If
you
you have
can
more amount, they are not concerning that amount.
so that they are deducting TDS on that, na?
Yes, yes. Suppose I have sold maybe 2 lakhs, I mean, gain.
Mm-hmm.
They are only they will give in ITR return 1.25 only from that.
Mm-hmm. Okay,
After
I
this
get it.
all, yeah, after TDS and all, form 16 or form 13, you said, right?
Yes, yes. So,
Yeah.
so after filing income tax return also, you are not getting the refund.
No, no, not getting.
Okay. Because in the TT it is clearly mentioned that it is an exempt income and you can claim. Actually, the withholding tax is done wrongly in your case, no? The withholding
Mhm.
taxes should not be done. Firstly, all first.
Yeah, exactly. Yes, yes, that is the reason. Yeah.
That is the thing. I'll get
Mm.
out. I'll get the solution for you in this case. I have
Yeah,
understood.
please.
I will
Yeah.
I will get you the.
Because the for equity, I know equity, no exemption is there. You have
Yeah,
to pay
equity there is no
20%.
exemption, but
You
mutual
have to
fund,
pay
many people.
20%, yeah,
Yeah,
flat.
I know many people in Saudi are claiming exemption in this mutual fund.
Yeah,
The
mutual funds are there,
But
but the
they deal directly with the AMC. What I know about them, they deal directly with the AMC and they give them TRC and NF, and the AMC doesn't deduct TDS on that. The Nippon
Mhm.
Mutual Fund, I know Nippon Mutual Fund are
Yeah,
quick on the response on this. Actually, it depends upon the mutual fund, na, the agencies,
yes, yes,
the
yes.
fund houses.
Actually,
If it is a small
from my
fund house, then maybe they don't
yeah,
care about it.
yeah.
The Nippon does it. Nippon does it, HDFC and all that, because they have mentioned on in their contract also that you can claim exemption.
Mhm.
But I'll sort out your query on this.
Okay.
Yeah, how can you get it?
Like,
Because
without
your is
broker,
a genuine
without
case.
broker or without this mutual fund agent, if
How
we
can
can
I
go
get it?
directly to AMC and submit our paper, they
Mhm.
like
Okay.
that.
Thank you, Bharat. I think
Okay.
we will get back to you. And
Ah,
in the meantime, I think you can just drop your email ID
yeah.
to on this chat box. Our team will reach out to
Okay.
you. And
Okay.
thank you for your question. And if
Thank you
anyone
so
has
much.
questions, I would like to just put your questions in chat box. I think it's a time for a 5 minutes break. But we have a little to detour for our in our break. We would like to introduce to our attendees that we are having a AMC, an asset management company from India. We have Karan Arora and Shubham Gupta from Green Portfolio. Green Portfolio manages north of 900 crores in asset across various investment classes and have been a top decile performing PMS for last 7 years. So I would like to, so we would like them to come and speak for 10 minutes. We have learned about saving money. Now it's time to earn more capital gain. So over to you, Karan and Shubham.
Good evening, everyone.
Good evening.
Yeah, good evening, Karan. Good evening, Shubham.
Hi everyone, how are you?
So let's start. So I think everyone
Okay.
is on mute and they are on a listening mode.
Okay. Thank you so much, Sumit, for the warm introduction. I just wanted to take this time to introduce everyone to Green Portfolio. We're a small fund house based in India, and we've been over the last 7+ years, we've been growing our clientele across the world, wherein the Gulf market is also a major chunk. So I'll just take some time, take you through a few slides of ours, and introduce you to our firm. So Green Portfolio was launched in 2018 as a PMS, as a SEBI-registered PMS. Over the years, we also started a research analyst business as well as recently a Category 3 alternate investment fund. We started off with just 5 crores, but now we are managing just north of 900 crores in the markets. We've been lucky enough to have a lot of investors support us through this. And so far, more than 70,000 investors have trusted us with their money. Just taking you through the journey as well. So, Our company was established in 2014, but we started officially as a SEBI registered licensed portfolio management service in 2018 with one of our funds. That fund started with a 500 crore corpus, and today the company is, as I said, managing close to 900 crores. A little bit about the team, founders, as well as the research team that carries the weight of managing your money carefully. We have two co-founders, Mr. Devam Sharma and Mr. Anuj Jain, both of them chartered accountants. Devam
Excuse me.
is also an MBA from ISB Hyderabad.
Sorry to interrupt, but are you sharing any slide? We can only see fine print section 54 and 54F slide.
Oh, I think Sumit, I think the PPT or the Zoom meeting is in focus mode.
Just a second. Sorry. Actually, I am able to see your PPT. Let me check.
For the audience, I think it would be on focus
I
mode.
could not actually.
I think Parveen is also able to see. I think in his case, his computer must have been, I think, struggling. Maybe it got hanged because I think everyone is able to see. I can see them.
Everyone is able to see. Maybe people can
Yes,
just
yes,
confirm on chat.
yes. Everyone is messaging. Then they can see.
Okay, thank you, thank you. So we can by the way share this deck later on for people who are
Okay,
not able
thank
to
you.
see it at this time, and you can go through it at a later stage. Just introducing you to the team, we also have Shubham with us here. Shubham is a senior research analyst on the team, and he is one of the people responsible for researching and bringing the right kind of stocks in your portfolios. Over the years, of course, a lot of awards and mentions. We got a 5-star rating from Crisil, as well as the top performing fund for calendar year 22 and financial year 22. Green portfolio as a whole has been a top decile performer with constant and consistent rankings in the top 10 PMSs in India. As I said, more than 17 countries. So our clientele is spread over more than 17 countries, and the GCC, mainly Saudi, UAE, Qatar, Oman, and Kuwait, are one of the focus areas for us. To let you know a little bit more about our offerings, we have something for all kinds of investors, all the way from retail portfolios where you can start off as low as 50,000 rupees to our category 3 AIF, which is a 1 crore rupee starting investment, where you get access to pre-IPO, private equity, as well as listed equities all in one fund. And it is a tax efficient vehicle as well. In the PMS, we also have across our funds, other than the funds we'll talk about, we also have a Sharia compliant and certified mid and small cap PMS fund. This is, as far as we understand, India's only small and mid cap Sharia compliant fund, which is properly certified by a certifying agency. In the future, we are also, actually in the very near future, we are also coming up with the structure in DIFC Dubai. This structure is going to be regulated by DFSA, and the minimum investment over there is going to be $50,000. This is going to be a USD denominated vehicle, which will pool investments in DIFC and invest in Indian equities. I'll take you through our funds and our performance now very quickly to give you an understanding of what kind of investing we do. One of the PMS funds that we are showing you today is the Super 30 fund. This fund was launched in September of 2019, so about 6.5 years ago. And so what we do here is we invest in small and micro cap companies, usually looking at turnaround opportunities. And how Green Portfolio as a fund house operates is we are very much fundamental oriented plus value investing as a thesis, right? So that's the kind of investing you get with us. Ideally, what you're looking at over the long term is about 20-25% CAGR in terms of performance. We've been able to beat these numbers in the recent past. However, this is what we are aiming for as a fund. In front of you, you also see the value of 1 crore invested since fund inception to now. Then I also wanted to showcase a few other funds to you. One of the unique offerings that we have is a dividend yield fund, which essentially is PMS fund, which is also offering a high dividend yield as part of the overall return structure. So, other than the capital appreciation that the fund will have a core focus on, you will also get cushion of about 3 to 5% as a fund level mandate uh, of dividend yield income.
And
Now,
while
granted,
not investing in any PSUs, we are not investing in any PSUs. We believe the PSUs are do not have any real owners where the sweat and blood of the owner is going. The government is running the PSUs, and anything can happen, as we saw in the case of oil. So we are hesitant to invest in PSUs. Other than that, the private companies we are looking into for the dividend yield fund.
yeah. And so here's also,
Just one question. These data, what you are showing,
yeah,
Yeah, yeah,
these you
absolutely.
totally.
can see
Yeah.
Absolutely.
see in SEBI website.
So you can
Yes,
go
yes.
to you can Google SEBI space green portfolio PMS and you'll get something along these lines. Other than that, you can also go to
Okay.
APMI, which is Association of Portfolio Managers India, where the same numbers are also filed, and a lot of agencies as well, such as PMS Bazaar and this and that, where you will be able to verify or cross-verify. All of the numbers that you see on the screen are submitted to SEBI. They are after expenses and fees but before taxes. PMS
Okay.
is not a pooled vehicle, so the taxes are basically in the hands of the
In the
investor.
hands of the investors, yeah.
Hmm.
I'll just move on to some of the other funds as well very quickly, and then probably we can do a very short Q&A on any of the offerings that were discussed. And other than that, I'll also be sharing our contact details. Special fund is the fund that we started our PMS with. Um, The special thing about this fund is basically it's a multi-cap portfolio. We skew it towards the mid caps mostly. However, we will not be shy of investing in large caps as well as small caps from time to time. Currently, in the current given Indian market scenario, we are very heavy in small and mid cap space with a small 25 to 27% allocation towards the large caps. Over the last 7.5 years, uh, almost now coming to 8 years in a few days, this fund has returned about 21.8% after fees and expenses. And lastly, as I mentioned in our PMS, we have probably India's only small and mid cap Sharia compliant PMS fund available to us. This is a fund that we launched in June of 2024. So not a very long time ago, unlike the other funds. This is more of a recent offering from us. However, what we are able to give to investors is a certified fund by a certifying agency, which also is the screening partner for the S&P 500 and the Dow Jones in the US. So the same agency that is certifying the Sharia version of these indices has partnered with us to work on the PMS fund here and help us comply with the Sharia certifying regulations. Uh, all investors in this portfolio get a certification every 6 months of the last of the transaction of the last 6 months, as well as an audit report.
Karan, this fund was launched. We were, I would say, unfortunate. It was unlucky when it was launched. The peer market immediately began in mid of 24. It was the peak of the bull market. However, our advisory services based on the Sharia theme are doing absolutely fine. So the before, if you guys color your mind regarding the returns, this fund would mirror the stocks of other Super 30 special, barring the stocks that are not compliant with the Sharia principles. So
Yeah.
going ahead over the longer period of time, the returns are gonna come.
So this particular figure can also be verified in the last 3 and 6 month return figures where the 6 months is at 12.5% and 3 months is at 17.5%. So the rebound is clearly there. Of course, the fund was launched at a time whenever the markets were in a corrective phase. Regardless, we were able to gain quite a decent amount of AUM through that corrective period. And if anything, the interest has only increased now that the markets have once again turned around. That said, the expectation from an investor looking to invest in a fund like this should be in line of what we just showed in the special fund, because even though we are going to be investing in the small and mid cap space in this fund, the average market cap of the stocks that you will get access to is going to be ranging from about 12,000 crores to 20,000 crores, right? So in that range. So it's a very healthy range wherein it's not a lot of micro cap as well. So the drawdowns as a whole on a fund level will not be very, very aggressive. Shall I move on, Shubham?
Yeah, correct.
Okay. So, I mean, that's about it on our products. Shubham is here with me, and I also have his details here listed. I would request if anyone has any questions on our offerings, now would be the time, as well as a thank you to Sumit for letting us do this and introduce our fund to your fellow attendees.
Thank you, everyone.
So now you have only new fund launching, or same it is going on PMS, same old schemes.
Shub, I didn't quite understand the question, but from what I think you're asking is, do we only have the
No, no.
PMS or other funds?
Now you are going to launch any new fund, or same what plans you are running, those you will be working in your PMS, or
So
any
what
new
we
fund.
so what we have in the PMS are the four funds that we've shown. Other than that, also we have a category 3 AIF, which is a pooled vehicle for HNIs, minimum investment 1 crores. And in this Cat 3 AIF, we are investing in 80%, like 80% of the allocation of your money goes towards listed equities, and the remaining 20% goes towards unlisted pre-IPO, where the runway to IPO is about 18 months or so. So about
Maximum.
1.5 years or so. So that is one offering from our side. The focus of this fund is going to be on the manufacturing growth story of India. So majority, more than 75% of the companies that you will see in this fund, be it private or listed, will be investing in this space. Other than that, we also, like I mentioned at the start of this PPT, is that we are coming up with a DISC structure, which will be a pooling vehicle for investors which are outside India. Essentially, as you would know, that uh, investing in India in general becomes a tax inefficient format for NRI investors or even foreign nationals for that matter. In various like in various classes of investment which involve equity. Of course, mutual funds in Saudi specifically have become easier. However, the other more aggressive, more exclusive asset classes such as an AIF or a portfolio management service are still on the more difficult side. Mainly when it comes to paperwork arising out of PIS requirements or KYC and re-KYC requirements and so on and so forth. Other than the fact that in PMS you will also need to have a tax filing base in India. If and for most investors, of course, because we have a lot of NRI clients now, we've learned that uh, this becomes a key pain point. So we've come up with a DIC structure that's going to be live in the next quarter or so. And over there, essentially, your international IDs and proofs will be the only things required. That's what the DFSA requires. So you will not be required to provide an Indian passport or Indian documents or file taxes in India, since Dubai is tax free, and the vehicle that the DIC structure invests in is basically tax free in the hands of investor. Because of these two things, the investment you make and when you exit pays for the taxes and then comes to you. And throughout the process, you do not have to incur either a tax filing procedure in India or a um, you know, or have the burden of paperwork with regards to your personal documentation in India. So these are the problems that would be solved through those structures in DISC. So this is something that's going to come in the next quarter. But when it comes to investing themes as a whole, the funds that I showed you are going to be more or less mimicked in all the structures that we have on offer. The reason for us to have a structure in place is to give the right kind of investor the right fit, essentially. An NRI investor would benefit a lot more from a AIF investment or a DIFC investment. However, someone who's looking to keep their money locally in India would also, be at the same place with a portfolio management service. So that's the overall offering with us.
Okay. Like suppose I'm holding some, many funds, and now I want to go for PMS. I can transfer to those funds to PMS account.
I'll take this, Karan. So essentially, it can be done, sir. Practically, it is possible. But since the day you transfer those securities to us, interest those securities to us, we would be held liable for the returns. You would ask what returns you have made. So we would ultimately be selling those securities, and a lot of paperwork would go while transferring those. So we request our investors to ultimately sell and then transfer the funds directly. That is the best that is for the fund as well as for the investor.
Okay, we have to sell it.
That is the most efficient thing that you can do. If you want to transfer, we can accept the transfer of securities. However, ultimately we are going to sell those, barring two or three that is overlapping with the PMS shares.
Mm. So in this selling process, what about the capital? Like, same question. We have to go
So
DTA.
Sumit ji and Karan ji would be helpful to you in that case.
So you mean we can save our capital gain?
Karan ji would be answering
Yeah.
those questions
No,
because
capital gain, because it will be a sale, na? Capital gain will be applicable. It cannot on transfer also capital gain is applicable.
Mm. Okay. So what is the process like if we go for, you said minimum how much? 50 lakhs for PMS?
Minimum for PMS is 50 lakhs. For the AIF, it's a
Okay.
1 crore. Yeah.
It will be on NRI status, right?
Yes, either
yes,
NRO or NRE, depending on where
NRE.
it is sourced.
Okay. Okay. So
We
what
can
will
have
be
a
the
detailed conversation, Bharatji,
what like
over virtual
what will
meet.
be the part, what will be my part, like how it will work? You will be working on commission base, or what is this
I think we can take
process?
Mr. Bharat's contact details and properly discuss over a call.
So thank you, Bharatji, for your questions. So I'll connect you with the green portfolio, and
Mm.
all the standard questions can be discussed. I think mutually with them,
Mm.
and again they are coming up with a DIFC structure, which will help you in case of your tax saving criteria. So
Mm.
I just want to say that our break, which was supposed to be 5 minutes, has been extended to 15
So I
minutes.
want to know in brief, like for the
Yes.
understanding each and every
So if
this thing.
if our attendees like to have such kind of webinar wherein we are promoting some wealth management practices, including AIF, PMS, so we would like
Mm.
to have for more sessions like this. Again, we are looking for the thumbs up from your side, and
Mm.
if yes, then I would be having a monthly sessions on various kind of wealth management,
That's
so
great.
that we all are aware and so that we can all
Okay.
earn capital gain and then contact to Karan to file taxation on that particular part. Thank you, Karan, and thank you, Shubham, for your presentation. And this was
Thank
something new that we tried to introduce this time. Next time we would be coming with little more thing. So back to Karan Aggarwal for our taxation thing. So right now, since we are short of time, so let's, Karan, we have another 20-25 minutes. So another 10-15 minutes to discuss on one or two topic. Then maybe if there's some questions, we can take that questions
Yes,
and
yes.
wrap it up. We
Okay.
have another sessions on our Income Tax Act, which we would be taking on next weekend, which is 11th of July. So I would like whomsoever is here to be a part of that also. And if you want sessions like Green Portfolio, we would be asking them to be a part of it. Thank you. Over to you, Karan.
Okay. So now the next chapter is income from other sources. The income from other sources is the residuary head under section 56, covering everything not covered by other heads. So rental income and salary, house property, capital gain. So anything which doesn't cover the four heads of income comes under income from other sources. So dividend income, winning from lotteries, interest on securities, income from machinery plant, any sum received without consideration exceeding 50,000, that is a gift. So all these income. So it is a residuary section, income from other sources. So income from subletting of a house property by a tenant is also other sources income. Subletting means that you have taken a property on rent and then you have again subletted it to another one. So in Goa, it is happening. In Goa, the BYOB concept has been taken place, and so now the subletting concept in Goa for villas is taking place. So that subletting is income from other sources, not income from house property. So you will not get any reduction, 30% reduction, 30% reductions you will not get in that income from house property, income from other sources. Director sitting fees is also income from other sources, income from undisclosed sources, rent from a vacant plot. That is a very interesting concept. Income from house property means house property income. So it should have a house building for to come it under house property income. But if you have an income from a vacant plot, so that vacant plot, if it generates an income, so that is income from other sources, not income from house property. Hmm? Interest on delayed income tax refund which you get on interest, that is also income from other sources. So that, so section 50, 115 BB, that is the winning from online lotteries and that. So that I do not take major impact on maturity proceeds. So that is the LIC maturity proceeds, that is exempt. That is a exempt income, section 1010D. So there is a policy issued from 1st April 2023 to 31st March 12. Exemption is locked if premium in any case exceeds 20% of the sum issued. Policy issued after 1st April, the threshold drops to 10%. So that exemption will be lost if the premium in any year exceeds 20% of the sum issued. So if you are paying a higher premium and getting a lower return, then LIC policy is not exempt, and then the TDS will also be deducted on the withdrawal portion, the maturity portion. None of the aggregate premium caps only for policies issued on or after 1st April. 5 lakh aggregate across one or more life policy and 2,50,000 aggregate for one or more ULIPs issued on or after. So that also exemption is not available. The gift. So this is a very important topic. Gift from resident to non-resident. Suppose a person, your uncle in residing in India, gifts you some money or some house property. So that income is also deemed to accrue rise in India, and that is taxable as per your slab rate in India, exceeding 50,000. So this was a loophole which the government has plugged in Finance Act 2019, where the donor is Indian but the recipient claims the gift is non-taxable because it is received outside India. So now it is taxable in India as deemed to accrue rise in India. So it is a Indian sourced for tax purpose, even though the transaction originates and received abroad. So that income is taxable for a non-resident gift. But if you are related, suppose your father gives, the relative definition comes into picture, then it is exempt. So the scope is covers any sum of money paid or property situated in India transferred without any adequate consideration. Payer must be a resident in India. Recipient must be a non-resident. applies where the aggregate value of such gifts exceed 50,000. If the threshold is breached, the entire amount is taxable as income from other sources. So, gift that remain tax-free is received from any relative on the occasion of marriage, under a will, or in contemplation of death of the pair. So, these are the exemptions for gift. Otherwise, if you take it from an unrelated person, then it is taxable. So purpose was to prevent taxpayer from shifting wealth out of India under the guise of gift to avoid tax on what is otherwise Indian source income. So Finance Act 2019, which I told you earlier, inserted clause 7, effective from assessment year 2021, covering gifts exceeding 50,000 paid on or after 5 July 19 by a resident or non-resident. So it was not covered for not ordinary resident. Now it has Finance Act 2023 has extended the deeming provision to cover to made to non-ordinary residents as well. So now all the resident, non-resident and not ordinary residents are covered by this provision, and gift will be taxable. So when gift become taxable, sum of money received without consideration, entire amount, immovable property received without consideration, stamp duty value if it exceed 50,000. So these are the chart where the gift is taxable. Does not apply is relative. Unexplained income. So this is the unexplained income section where if in any India you take a amount which you cannot explain, so credits, suppose you take 5 lakh 10 lakh from any person as a loan and you can't prove that the person identity, then that income is called unexplained income. So for that you have to pay a very high rate of tax. Cash credits found in the book with no satisfactory explanation, unexplained investments, unexplained money, investment understated, unexplained expenditure, amount borrowed or repaid on hundi. So these are the unexplained income or expenditure which you can't explain. So the source you can't explain, that is taxable at 78. Effective rate is 84%. It is a very high rate for income which you can't explain. So that's why I tell non-residents to maintain books of accounts or keep a track of the saving bank passbook, NRO accounts, from where you are receiving money, and make an Excel of that passbook and show it to your chartered accountant that these money are correct sourced, so that he can file your return accordingly. So income transferred without transferring the underlying asset, that is taxable in the hands of transferor. These are the clubbing provisions. Remuneration of a spouse. Suppose you income from asset transferred to a spouse is clubbed with the transferor and son's wife. So these are the clubbing provision. Minor child income is clubbed with the parent whose total income is greater. So husband, wife, and son's wife. These are the clubbing provisions where you can suppose you transfer amount to your wife and the wife takes a property in her name and the rental income comes, so that rental income will be taxable in the hands of husband and not wife, because you have transferred without transferring the you have transferred an asset to a spouse. Set off carry forward. So income from other sources loss you can claim against all heads. House property loss is capped at 2 lakh for inter remainder can be carried forward but can be adjusted against all heads. Business loss, all heads except salary. Speculative loss, only speculative profit. So these are the important things. Long-term capital loss, only long-term capital gain, and short-term capital loss can be adjusted against long-term capital gain or short-term capital gain. So long-term capital loss can be a set off against long-term capital gain, but short-term can be adjusted against both long-term and short-term. So that you can in the March you can make a planning and accordingly sell your shares or mutual funds accordingly, so that set off is possible. So these are the losses which can be carried forward also for 8 years. House property loss, business loss, speculative loss, long-term loss, short-term loss. Speculative loss can be carried forward only for 4 years. Other losses can be carried forward for 8 years. These are the reductions. Chapter 6 highlights old regime 2 lakh, 80C is 1 lakh 50,000, 80D Mediclaim, 80CCD. But nowadays, I think all the person should use new regime. This is the new regime. So up to 4 lakh is nil, 4 to 8 is 5%, 8 to 12. So ultimately, I think the new regime is beneficial for all because the tax rate comes lower and you don't have to waste your funds in investing in deductions. So I give my clients the suggestion that go for new regime and save your money and don't waste in taking deductions and block your money. So the new regime is very simple. Four up to 4 lakh is nil, 4 to 8 is 5, 8 to 12 10, 12 to 16 15, 16 to 20 20, 20 to 24 25. Above 24 is 30. So tax rates have become very easy. So new regime is very good for non-resident as well as resident. The filing dates for a non-resident which has a salary and other capital gain income, the date is 31st July. If you have a business income, the rate is 31st August. Partner of an audited firm, October. So the 31st July date is coming. So all the persons who have salary, capital gain and other sources of income, 31st July is the last date. So advance tax have to be paid in 4 installments, 15 June, 15 September, 15 December, 15 March. 15%, 45, 75 and balance. So interest is charged if you don't pay the advance tax in time. So advance tax should be paid if you have a income which you know that in the finally you have to pay self-assessment tax. So higher income people should plan accordingly and pay advance tax so that interest can be saved on advance tax. 234 ABC interest can be saved if you properly deposit advance tax in time. So ITRU is a new concept where you can file 4-year returns. So if you have forgotten to file your returns for previous year or 4 years previous to the relevant current year, you can file an updated return. For that, you have to pay 25% tax extra within 12 months, 50% within 24, 60% 36 months, 70% within 48 months. So if you pay extra tax, if the tax liability comes, you have to pay extra 25% for filing return before for the last year. So it is a penalty nature tax, but you can file. For previously, you can't file the returns for last 4 years, but now you can file with after paying penalty tax of these 25%, 50%, 60%, 70% additional tax. So that can be done for ITRU. It is called an ITRU. So for documents is that you gather your balance sheet, P&L, capital account, fixed asset ledger, 26CS, TIS, EIS, salary certificates. All these documents you should keep ready for filing your returns. So brought forward losses, unobserved depreciation, updated master data and software address, PIN for partnership. So all these documents, because nowadays in India, all online information is available. Tax identification, TIS and AIS, you get the information about the rental income, sale of property, sale of shares. So all this information is available. So from that you can check where what sort of income you have, and accordingly you can cross verify and then file your return according to TS, because if it doesn't matches then notice can come. So accordingly 26 years TIS and AIS are very important for filing your return. Compute total head income wise. AIS, TIS books of accounts should be tallied. For capital gain, always record sale price and purchase price separately. This provides an audit trail and matches AIS data. So accordingly, you can calculate your capital gain. And before filing your preparation computation, please decide to go to old regime or new regime. And I give a suggestion that you go to new regime, AIS and SFT. So AIS is a comprehensive view of taxpayer information, 26 years split into part A, part B. So covers all the reported data, salary, rent, dividend, interest. So all the things which you have done financial is coming into AIS. So nowadays you don't need any documents.
The salary and all you are talking for Indian resident or
Indian,
NRI?
Indian, Indian, Indian,
Yeah,
Indian.
yeah, yeah.
All
Because
the Indian income.
you are listening for us as a NRI. That's why I'm interrupting.
No, no, no.
Sorry for the interruption.
Non-resident also, if a non-resident has sold a property in India, then also
That is
AIS.
okay. That understood. Yeah, that
Yeah,
understood.
and the shares, if you have Indian shares also, that also comes into picture. The FD, because many
Yeah.
non-residents have FD for fixed deposits and interest income. So all this will come into AIS, and then we can
Mm.
use that AIS to file the non-resident return.
Karan, one query. If somebody's got a contract from Saudi Arabia and he has an option to work from home and he's based in India for more than 182 days, how will that impact? Could you just briefly share that as well? Because nowadays, many of them are working on consultant mode, and there is an option to work from home. People do work from home from Saudi Arabia as well as maybe in India. And during that course, if they end up staying more than 182 days in India in during a particular from April 1st to 31st March, how will it impact their assessment, liability and residential
If
status?
because the passport is the proof for residence, how many days is in India and how many days in Saudi, because income tax department cannot track the residency status. So when the assessment comes, they need the passport. So if they prove that you are in more than 182 days in India, according to the passports, and you are a resident, so that in that case you have to file as a resident tax individual, and your global income will be taxable. So the first thing is that you have to decide whether you are a resident, or you have to file as a resident or non-resident. If you are a resident, then your global income is taxable. It is not a matter of whether you are working from home or in Saudi. If you are in India, physically presence in India, and you are covered under that section of residency 182 days and 60, then you are a resident. If you are proved as a resident, then your global income is taxable. There is
Yeah,
no.
very
Okay,
true.
thanks so much.
So you have to be very careful, because I have many cases in which the client told me that he's a non-resident, and we filed as a non-resident, and when the case came, and we filed the passport, he required the passport, and he proved, the income tax department proved that he's a resident. So his all the other income of all over world was taxable in India. So you have to be very careful in deciding whether you are resident or non-resident. Physical presence is important. So passport is a main
Yeah,
physical.
I believe nowadays they also ask number of days stayed in India during that period in the return itself. I guess
Yeah,
it's
yeah, yeah,
being
yeah.
that information.
Correct, correct,
Yeah.
correct. Now
So
form
it's
has
better to
changed.
declare that upfront rather than,
Yeah, yeah.
getting
That's
into
why
any
we
hassles
ask.
later.
Yeah, yeah. That's why we ask the passport of non-resident to be given.
Yes.
But
Yes.
many
Thanks.
times
Thanks so
what
much.
happens is the many people have so much entries in passport that we can't track. He can't track how
Yeah.
many days was in India. So that's a
Actually,
very big deal,
I
because
think it
I
is
have a.
up to the person, SSC, to declare it
Yeah, yeah,
himself rather
yeah.
than.
That's why I asked from the SSG, because I have a clients in BCG, Boston Consulting, and Big Four. So what is they travel very much from India and America, and India and America. So they don't have the track
Right.
how many days when in India. So that is a very,
Sorry.
but
Yeah.
we try that, because if you are a non-resident, there is a one big benefit. The big benefit is that if you are a non-resident and filing as a non-resident tax return, you don't have to declare any foreign assets in income tax return. If you are a resident, then you have to declare all the assets of all over world. Even if a small bank account, if you have opened in Saudi, you have to declare that I have a bank account in Saudi. If you are a resident, if you are non-resident, that only resident income is taxable, and no disclosure is required about the financial assets all over the world.
Yeah, thank you. It's a very important point. Sorry, one quick question on this.
Mhm.
Last 3, 4 years, I've been NRI, but
Mhm.
unfortunately, the tax which is being filed
Mhm.
was filed, I believe, as a resident, and the
Mhm.
income that I was getting had also been calculated. And unfortunately, I had paid some tax initial
Mhm.
years, 2 years back, or rather, even until last year. So, is there any way that I can still call back that amount, because it's not taxable at all, and it's residing in my NRE account actually?
You have filed as a resident, and what happened after that?
It has been filed as a resident.
Mm-hmm.
Uh, I need to check in detail with my CA, because the amount which I disclosed with him about the income that I'm getting from the firm in Saudi while I'm staying here,
Mm-hmm.
I think he calculated that as well as an income, which he should not have calculated.
Because his global income, he has calculated as a global income taxable return, na?
Exactly. Yeah,
Hmm.
yeah. So my question is, can I still, ask for the refund of that? Is it possible?
The assessment has been done. The 143.1 order has come. There
I
is a processing of order 143.1.
Okay, that I'm not sure of.
You
Can I
ask
check
the
it logging into my IT login? I can check it there.
Yeah, you can check 143.1 order. If you have received, then the return is processed. You can file a rectification application against that order for 4 years. So
For 4 years. Okay,
4 years after that order has been received. So 143.1 order, you can file a rectification application.
okay. So any correction need to be done until 4 years, we can do that.
Yeah, we can do after the 143.1 order.
After, okay, all right.
That return may have must have been processed, but that is a very risky thing. What will happen now, that if you
Hmm.
are filing as a resident and you have not declared the all over world the bank details and that, so the income tax department have the exchange of information formula now with all the countries. So what is happening
Hmm.
is that a resident individual is getting notice that you have a income in Australia, income in bank account in there, mutual funds in Singapore. So how come you have not declared that there is a penalty of 25 lakh rupees on non-disclosure? I have received notices on that also.
Okay, but that would be in case the person being actually being a resident of India.
Yeah,
If
yeah,
it is
resident of
NRI
India.
still,
Yeah, yeah. You have to in this case you should definitely file a rectification and to convert it into non-resident. Otherwise, you
yeah,
cannot receive the notice.
yes, yes,
You
because I've
should,
been surely NRI for last 4 years.
yeah,
My
yeah, should,
passport will
yeah.
track that. Yes.
Then you should file the rectification and change the status to non-resident in that years.
Okay, great, great. Thank you very much.
So AIS, SFT is done, and TRC, which we told you for TT relief. Now there is a very big amendment which I want to share with all the non-residents. In income tax 2025, previously, if you know that only tax residency certificate was sufficient for claiming double taxation relief, and 10F was needed only when the TRC did not contain all the information like email ID or address or tax year concept. So TRC was sufficient for claiming TT relief. Now they have mentioned in the section that TRC and 10F, it was or previously, now it is and. So TRC and 10F both are required for claiming TT benefit. So now we ask for TRC and 10F both for non-residents from non-resident for claiming TT benefit, and concept of TIN number is also now applicable. Tax identification number is also required for us to file the 15 CB CA form for claiming TT relief. So now you have to be very careful. You need three things: TRC, 10F, file online. 10F is to be filed online on income tax website, tax residency certificate, and tax identification number. These three things are needed for claiming DTA benefit in India. So you can withhold lower rate of tax only if you have three things. So all the non-residents should apply each year for if they need or they don't need. Otherwise, also they should have these documents so that they can claim TT relief. So return filing for non-resident is ITR 2 is for no business income, ITR 3 is for business income, and ITR 6 is for foreign companies. Return filing is mandatory if in India income exceeds basic exemption limits to claim a TT benefit or where a PE connection exists in India. So return filing is important if your income in India exceeds the basic exemption limit or you want to claim a TT benefit. There was a question that mutual fund has deducted TDS. So for claiming a TT benefit, you can file the return and claim the refund back. I don't know why he was not getting the 1,25,000 and the balance refund was not applicable, but you can claim the refund. Exemption exists under section where income is if the income is limited to dividend, interest, royalty, FTS, then with full TDS deduction, then you can not file your return and it is not obligatory for limited to dividend, interest, royalty, FTS. So for these sections, if TDS is properly deducted and you don't want to claim any refund, then you can do away with the return of income. Procedural sections and return filing do not apply where there is no charging liability at all under the Act or the DTA. Across gift, house property, capital gain, TRC, and correct residential. The last line is the crux of my presentation, that the correct residential status determination and DTA analysis are the foundation of accurate non-resident taxation. So the correct residential status determination and DTA analysis are the foundation. So non-resident taxation is governed by two things only: residential status and DTA benefits. So if you do these homeworks properly, then you can do correct tax planning and correctly file your income tax return. And litigation is not possible in that cases. So that's it. Thank you. Thank you, everyone. If you have any question, then you can put it in.
Thank you, Karan. Thanks for this wonderful presentation. This has been really helpful and helping all the NRIs solve all the tax queries, especially in this tax season. So this was indeed helpful. And I know there are questions that are coming in